Alright, so I'm going to go over long call vertical spread options. These are also called bull call spreads. This is a bullish play, predicting a moderate jump in the stock's price. And we benefit the more the stock price goes up. And we also limit our losses by only putting a certain money up forward and never losing more than that. So the benefit of this play is that we can only put a small amount of money forward to make profit on a moderate jump of the stock price. So first we have the stock and its options. Let's say a stock is trading at $50 and we think this month the stock price will jump up. So we can plan to place a long call vertical spread to predict this movement while only putting a small portion of our cash up front, and this limits our losses. We buy 5 call options for $1 each at a strike price of $52. So if the stock price goes above $52, we get to purchase 500 shares of the stock at $52. And this cost us $500 to purchase these options. So to complete this vertical spread, we will also sell calls. We sell 5 call options for 50 cents each, and this is money that we get for a strike price of $55. Because we paid the $500 for the options we purchased, then we received $250 for the options we sold. Our maximum loss would be $250. Now with these options, we will be obligated to buy 500 shares at $52 and sell 500 shares at $55 if the stock price is higher than both strike prices at expiration. So now what can happen with this? So the best result is if the stock price moves above what we sold the calls at, which is $55. So if the stock is trading at $56 during expiration, both our options can be exercised. In this case, we buy 500 shares at $52, then we sell 500 shares at $56. So now we profit $1,500, but we also have to consider that since we paid the $250 for the calls, we have to take that out of our profit. So our net profit is $1,250. The second situation that can happen is that the stock price goes in between the strike prices. So if the stock is only trading at $54, our sold calls are not exercised because their strike is $55. So in this case, instead of exercising our calls that we purchased, which is what we were going to do to buy 500 shares at $52, instead of doing that, we can sell the calls for profit because it would cost more to buy more of these calls since they are in the money, as in the strike price is below the stock price. Now the final situation that can happen is if the stock instead drops below the $52 or never gets there. In this case, both the options expire worthless and you lose the $250 investment that you put up front. And these are also called bull call spreads, and they have an upside through a small movement just above the strike prices we choose. So the best thing about these options is that it limits your loss. So you can never lose more than you put forward. And in this case, you can only put forward a certain percentage of your portfolio each time, and you choose the risk. So that was the video. I hope you learned about options. They can be pretty complicated. So make sure to go look at examples yourself. Also, comment below with the company I should analyze this Sunday.